Shorting is quite simply the attempt to make a profit from a falling rather than a rising share price. It's exactly the opposite of going long, and I think our industry is so used to buying something and hoping that the price rises, something that's undervalued, whether that's a residential property for us as investors, potentially even a vintage bottle of wine. We're all used to trying to buy something and hope that the price rises. This is just exactly the opposite. It's actually selling something and then buying it back at a later point in time. Logistically, it's really easy. It's only 4 steps. The fund manager will go to the broker and will borrow a security in Company A. Let's assume Company A is trading at $50. If the view is that Company A shouldn't be trading at $50, you would actually short that, so it's sold immediately. At a later point in time, whether that's tactically at 3 months or strategically, say 12 months, you would hope that that price is less. Let's assume it's $25. At that later point in time, you buy those securities back and return them to the broker. 4 really simple steps. You've still made $25 a share, but you just haven't bought and then sold, you've just sold and then bought. Because shorting adds a whole extra layer of flexibility to a mandate, it's a great diversifier. It's a great diversifier because you can hold higher cash levels. Remember, we've sold that security and we will buy it back at a later point in time. As a result, we can actually use that cash on the long side if we'd like to invest. Hence why a lot of these strategies are called active extension. Because it actually profits from both a rising and a falling share market, and indeed share prices, it can actually reduce overall portfolio volatility. So if an advisor or a client has a portfolio of direct equities or a portfolio of long-only managed funds, adding shorting can actually provide a cushioning effect in a falling market. Shorting is a specialist skill because you're looking at exactly the same security but through a fundamentally different lens. Instead of trying to find hidden value in a company that the market hasn't recognised, you're trying to find parts or elements in that company that are either overpriced, that are expensive, if the business is in structural decline, if there are competing threats, and taking a look and saying it's actually not worth what the market is paying for it today. It's actually only worth half, or it's actually only worth a third. To do that, though, requires a very, very different mindset, and there's not many people in the market that can actually do it very, very successfully. Risk management is key in any type of active extension or hedge fund style strategy. The illustration I'd probably refer to, arguably the most famous illustration, occurred in 2008. And it was where the shares in Volkswagen, which were trading at 100 euros, went to 1,000 euros on the same day. And it became the biggest company by market cap in the world, bigger than Apple and Google, temporarily, because there was such a short squeeze on those securities. In other words, everyone was trying to buy, but no one was willing to sell. Consequently, or as a result, really strong risk management plays a vital role in managing that portfolio. In other words, forcing you to close or cover that position if it is going against you. In other words, the price is rising rather than the price falling.